This is Nightly Business Report with Sue Herrera and Bill Griffin.
Trade tensions flare. Optimism fades around the U.S.-Chinese talks just days before high-level negotiations are set to begin.
Alive and well, despite all of the market challenges, we'll talk to one strategist who says, don't bet against this bull.
Rising risks. How oyster reefs are protecting coastal real estate from erosion and storm surge. Those stories and much more tonight on Nightly Business Report for Tuesday, October 8th.
Good evening, everyone, and welcome. Investors would love to see an end to the trade war between the U.S. and China, but experts say it's likely you're going to have to wait. Stocks fell sharply today as tensions between the world's two largest economies escalated just days before critical high-level talks begin and higher tariff rates are scheduled to take effect. Here are the closing numbers. The Dow Jones Industrial Average fell 313 points to 26,164. The Nasdaq was down 132, and the S&P 500 slid 45. We begin tonight at the New York Stock Exchange and Bob Pisani.
It was another tough day of trading. Stocks selling off as optimism falters around a U.S.-China trade deal. But we ended right near the session lows. So once again, the markets find themselves beholden to these trade talk headlines, and tensions are escalating as the week drags on. Stocks started the day lower on news that the U.S. would be adding more Chinese companies to its export blacklist. Then it fell further on word that the Trump administration was considering ways to limit U.S. investments in China, like cutting down on investments made by U.S. pension funds. Predictably, that put a lot of pressure on the usual cyclical names, banks and materials and retailers, and it's taken a toll on chip makers like Qualcomm and Broadcom and Intel. They all get between 30 to 60% of their revenues from China. So around 3 p.m. Eastern time, the markets took a sharp return south on news that the U.S. Department of State would be imposing visa restrictions on some Chinese officials linked to the detention of Muslims in China. Supposedly. The market is increasingly coming to believe a trade deal, even an 80% deal, most of the way, might be unlikely this year, and that means that lower growth may carry over into 2020. Finally, Brexit fears could also be adding to the nervousness. Some are concerned the British exit from the European Union will likely not end with a deal. A top official said a Brexit deal is essentially impossible following a phone call between British Prime Minister Boris Johnson and German Chancellor Angela Merkel. The two sides are slated to reach a consensus by October 31st, and so far sources are saying any extension of that deadline is very unlikely. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, even before those visa restrictions were put in place, China made it very clear it's not happy with the tone coming from the U.S. right now. Eunice Yoon is in Beijing for us tonight.
China's message to the U.S. today: butt out of our domestic affairs. At its regular press briefing, the foreign ministry criticized the Commerce Department for expanding its blacklist to include more Chinese entities on the grounds of violating the human rights of the Muslim minority out west, known as the Uyghurs. The ministry hinted that it could retaliate, saying Beijing would continue to take firm and resolute measures to protect its sovereignty. Many of the listed companies, like surveillance camera firm Hikvision, said they oppose the ban, which would block American tech firms from supplying critical components. The U.S. decision will likely complicate talks set for later this week. The Commerce Ministry today confirmed that Vice Premier Liu He will be in Washington for high-level discussions Thursday and Friday with his U.S. counterparts, Trade Representative Robert Lighthizer and Treasury Secretary Steven Mnuchin. Prospects for a deal already appear dim after weekend reports suggested that China would take state subsidies, a long-standing sore point of the U.S., off the table. Analysts are skeptical about a major deal this week, and some believe that the two sides might only agree to meet again in Chile at the APEC summit in November. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Just as talks between the U.S. and China are tense, so are discussions between the United Kingdom and its European counterparts when it comes to Brexit. As we mentioned, the UK Prime Minister wants to leave the European Union with or without a deal, and the clock is ticking. Willem Marx is in Luxembourg tonight.
It was a phone conversation that cascaded a currency. The British pound weakened sharply Tuesday after the German Chancellor reportedly laid down some Brexit red lines in a call with her British counterpart. Angela Merkel has been in the job almost 14 years. Boris Johnson, not yet 11 weeks. While Brexit's economic and political challenges may have forced these two very different leaders to talk together, the British side today said their positions still remain far too far apart. Last week, Johnson's representatives arrived in Brussels with an entirely new roadmap to guide Britain out of the EU.
Why are you here, Mr. Frost?
It asked the Europeans to change their current stance on customs checks at a currently unchecked and legally invisible border between Ireland and the UK. But so far, Brussels has refused to budge. And in Westminster, that's raised the parliamentary pressure for Johnson and his pro-Brexit allies.
It is now time for the EU to move too. If it does, then there is still every chance that we can leave with a new deal. However, if the EU does not move, this government is prepared to leave without a deal on the 31st.
On days like this, when no deal looks even a little more likely, traders tend to sell the pound to calm their concerns. Impartial but still scathing analysis released Tuesday shows that leaving without a deal would desperately damage the UK economy and balloon British debt to a 50-year high. And in neighbouring Ireland, a new budget also out Tuesday used no-deal Brexit as its baseline assumption. The Irish government may have to borrow around $1.5 billion to support Ireland's businesses if profits suffer as anticipated. Tomorrow, when most of Europe's finance ministers gather for their monthly meeting here in the EU's smallest member state, Luxembourg, each of them will be all too well aware of what a no-deal Brexit could mean for their continent's already faltering economies. Diplomats say the outlines for an agreement should be sketched out before EU leaders meet Johnson next week. The head of the European Council, Donald Tusk, will host that meeting. But today he accused Johnson of trying to win what he called a stupid blame game in case talks break down. Meanwhile, the Prime Minister's parliamentary critic said Downing Street's account of the Merkel call was a deliberate dog whistle designed to provoke racist resentment towards Germany.
Has then sparked a series of, frankly, racist attacks.
Britain's negotiating rhetoric and its currency may recently have been driven in a more negative direction. But tonight, 3 years on, the final destination for Brexit still remains uncertain. For Nightly Business Report, I'm Willem Marks in Luxembourg.
Meanwhile, in separate speeches today, the leaders of the World Bank and of the International Monetary Fund both warned of a weakening global economic outlook. World Bank President David Malpass said that growth is slowing because of Brexit, Europe's recession, and trade uncertainty. And in her speech, new IMF Managing Director Kristalina Georgieva said the global economy is now in a synchronized slowdown. Both organizations hold their annual meetings in Washington next week.
And then there is the Fed. For a short while today, comments from Fed Chairman Jerome Powell helped cut the market losses in half. Though short-lived, it is a reminder of just how powerful the central bank can be. Steve Leisman tells us what the chairman said and why it's important to investors.
Fed Chairman Jerome Powell 7 times in a speech Tuesday said interest rate policy, that is whether they go up or down, will depend on the data, the economic data, that is. He added that the economy is in good shape overall, despite some troubles on the horizon.
Many indicators show a historically strong labor market with solid job gains, unemployment at a half-century low, and rising prime-age labor force participation. But there are risks to this favorable outlook, principally from global developments. Growth around much of the world has weakened over the past year and a half, and uncertainties around trade, Brexit, and other issues pose risks to the outlook.
What's it all mean for the outlook for rates? While Powell did appear mostly neutral about what the Fed will do at its late October meeting, markets took his comments as affirming their expectations for another rate cut. J.P. Morgan writing in a commentary after the speech, quote, if the Fed leadership wanted to push back against market expectations of another ease later this month, we think Powell would have chosen language that didn't call out downside risks to the outlook. Speaking in Denver, the Fed chair also said the central bank will begin increasing the size of its balance sheet. That reverses a policy from last year where it was reducing the balance sheet, swelled during the financial crisis, to a more normal level.
Growth of our balance sheet for reserve management purposes should in no way be confused with the large-scale asset purchase programs that we deployed after the financial crisis. Neither the recent technical issues nor the purchases of Treasury bills we are contemplating to resolve them should materially alter the stance of monetary policy.
This was a major opportunity for Powell to change the market's expectations for the late October meeting, and he seems to have chosen not to do so. So it looks like another rate cut, another 25 basis point rate cut, is on the way to being delivered by the Fed right around Halloween. For Nightly Business Report, I'm Steve Leisman.
So, from the Fed to warnings of a weakening global economy to the ongoing trade war between the U.S. and China, there's Brexit. The market certainly is not without its challenges right now, but our guest tonight says the bull market is still alive and well. We welcome back our friend Jeff Sott, the market strategist at Capital Wealth Planning. Jeff, good to see you again.
Always a pleasure.
But if the global economy is slowing down, that has to take a toll on earnings. Tariffs are still in place. That's taking a toll on earnings. What's going to power this bull market higher in your view?
I think it's going to be earnings. I mean, you know, Steve Leisman and my dear friend Arthur Cashin are two of the calming voices on Wall Street. And there's not going to be you know this about me. I lived in D.C. for a long time. I'm still pretty well connected in D.C. There's not going to be a trade deal with China in the near term. Earnings have slowed, but they're going to reaccelerate as we get into 2020. The economy's not going into a recession. GDP growth's probably going to be slow at about 2.25%. But that's actually the mother's milk for a decent stock market. And people, I'm telling you, I'm out here speaking not just to portfolio managers, but to individual investors, and they're not just cautious, they're scared to death, and that is not the way secular bull markets end.
We are, however, hearing from companies that have reported their earnings in this past quarter and some that are starting to report now that the lack of a trade deal, the tariffs, and the dollar are all having an impact. What makes you think that companies will be able to overcome those headwinds?
Because I think the economy is going to re-accelerate, Sue, and I think if you're using Ed Yardeni's estimates for next year, he's around 177, 178, and my work shows that a fair market multiple is 19 times earnings in this low interest rate environment. Put a 19 multiple on 177, $178, you're talking about 3,200. And I would remind CNBC.
3,200 on the S&P you're talking about.
Yes.
Yeah.
I would remind CNBC that for 3 weeks at the end of September, I admonished that our models that called the August low were telling you to be very cautious in the first part of October.
It's a market of stocks, though. I think you've told me many times before, not a stock market. So who will power us higher? Which sectors do you like right now, Jeff?
Well, you know, Wall Street will always, 55 years of looking at markets and 49 years, my gosh, I'm getting old, in this business, the investors will always pay up for true growth. So technology is probably at the top of the list. I still like financials. It's not been a good place to be for a while. But I like energy, particularly the midstream master limited partnerships. Where I don't like is where everybody crowded into utilities and consumer staples.
Jeff Sott with Capital Wealth Planning. Always good to see you. Thanks for joining us today.
Pleasure.
You bet.
If the Fed wants to hit its inflation target, it may have to wait. The prices businesses receive for their goods and services unexpectedly fell in September, posting the biggest decline in 8 months. According to the Labor Department, the Producer Price Index was down 0.3% from the previous month, in part because of a pullback in trade services.
But there is apparently inflation in the price of some drugs. According to a new report out today, 7 prominent medicines saw price increases above the rate of medical inflation, which cost Americans an additional $5 billion over the last 2 years. That study concluded that none of the price hikes had been adequately justified. Companies, though, make those 7 drugs have criticized that report for not factoring in the value of their drugs and the lives saved. Still ahead, a trip to coal country.
President Trump's promises to save the U.S. coal industry are running into a bit of a roadblock. It's called the free market. I'm Scott Cohn in Gillette, Wyoming, the heart of coal country. We'll see how they're coping coming up on Nightly Business Report.
For several years now, the so-called millennial generation has been the focus of retailers and marketers because of its size and buying power. But as millennials age, Attention is now turning to the next generation referred to as Gen Z. And according to Piper Jaffray's annual survey of teenagers, this group is spending less, just about $2,300 on average annually. And that is the lowest spending level since 2011. But it's what they're spending their money on that interests investors and retailers. For males in that category, food comes first. Clothing is second, video games third. For females, it's clothing, then food, then personal care. When it comes to restaurants, Chick-fil-A is still number one, just as it was with millennials, followed by Starbucks and Chipotle. Nike remains the top apparel brand for 9 years running, followed by American Eagle Outfitters and Adidas. And when it comes to watching videos, teens are now choosing YouTube over Netflix for the first time ever.
Domino's did not have the quarter that many were hoping for. The company reported weaker than expected third quarter earnings and revenue. That sent the stock initially lower, but then later in the day, the CEO said the company would repurchase $1 billion in shares, and that gave the shares a lift. Kate Rogers has more on Domino's quarter and its strategy.
A tough quarter for Domino's, the world's largest pizza company by retail sales, as it faces pressure from emerging players. Domino's cut its long-term guidance, citing market uncertainty and competition from third-party delivery companies like Uber Eats and Postmates, which make ordering food easier for you and the restaurant. Many of Domino's competitors have teamed up with those outside delivery brands, but Domino's went in a different direction, believing its best long-run strategy is to handle deliveries in-house instead.
We've had a very strong and profitable delivery business for many years now, so unlike a lot of the other restaurant brands, we don't have to decide to get in or not, or try to figure out which of these third-party aggregators is ultimately going to be the winner at the end of this shakeout. We're really focused on, continuing to build that delivery business with our franchisees and doing it in a profitable way for them, and we believe that means doing it on our own.
The brand is in the midst of a major expansion plan to open more stores close to one another in order to shorten delivery times and capitalize on the carryout market, which analysts at Guggenheim say represents a bigger opportunity than delivery does.
It's about getting more stores on the map closer to our customers, because the number one criteria when consumers choose is convenience with carryout. And so we're going to continue to build more units and get closer and closer to them.
On the earnings call, Allison called the move proactive, not reactive, and defended Domino's strategy while also maintaining that a shakeout is coming to the delivery industry. One message was clear: Domino's isn't letting one rough quarter change its game plan. For Nightly Business Report, I'm Kate Rogers.
Boeing's deliveries are almost cut in half. That's where we begin tonight's market focus, with the world's largest plane maker saying it delivered 302 planes so far this year. That's down 47% from the same period last year. And it trails rival Airbus's deliveries of 570 aircraft. Boeing also said today that last month it booked its first order for a 737 MAX plane since April. The order was for a single plane. Boeing did not identify the buyer. Shares fell a fraction today to $374.10. Chemicals producer Celanese is reportedly undergoing a strategic review that could end up with a breakup of the company. Bloomberg reports that the company is working with a financial advisor and that the review is in its early stages. Shares fell more than 1% today to $117.85.
Helen of Troy, which includes brands like Braun and Vicks, had strong sales, which helped the company top analyst estimates. The consumer products company also raised its full-year outlook, but shares fell nearly 3% to $154.60. Late tonight, a Pennsylvania jury said Johnson & Johnson must pay $8 billion in punitive damages. The trial was related to the risk of male breast growth linked to Risperdal, a psychiatric drug. The stock fell in initial after-hours trading.
President Trump's promises to save the U.S. coal industry are proving to be no match for the free market. Natural gas and wind energy are now both cheaper sources of power, and that is creating some big challenges in coal country. Scott Cohn reports tonight from the nation's biggest coal-producing state, Wyoming.
In the heart of Wyoming's coal-rich Powder River Basin, Gillette bills itself as the energy capital of the nation, which made more sense a few years ago.
At one point, we were serving 40% of the nation's needs of energy, and it has declined. Now it's probably in the 20s, 25, something like that.
Just this year, 2 mining companies with operations in Gillette declared bankruptcy, temporarily throwing 600 people, or 3% of the county's workforce, out of work all at once. Coal production statewide is down 30% in 5 years.
Definitely is a time that Wyoming's got to think about its future, what the future of coal is.
Never mind the promises by the president.
Coal is coming back. Clean coal is coming back.
This is economics. Electricity from natural gas costs as little as half of power from coal, thanks to technologies like fracking. Wind energy, increasingly abundant, can cost even less. And that's making coal-fired power plants like this, an endangered species in many parts of the country, the equivalent of about 25 power plants either retired or converted to natural gas last year alone. With demand in the U.S. dwindling, companies in Wyoming and other western states have been seeking to export their coal overseas, blocked so far by West Coast states on environmental grounds.
We are actively looking at what a lawsuit would look like.
In the meantime, they're trying to turn the economics to their advantage, inviting researchers to set up shop in the shadow of Gillette's Dry Fork power plant to study carbon capture, ways to make coal more cost-effective and environmentally friendly.
Is there an opportunity to take that CO2 and instead of it being a liability, to turn it into some type of an asset?
But that could be years away. These challenges are here and now. Wyoming's budget, its economy, and its identity are at stake. For Nightly Business Report, Scott Cohn, Gillette, Wyoming.
Coming up, little oysters are being used for a big task to help protect coastal real estate from more intense storms.
There is a surprising new weapon in the battle to preserve our shores from rising sea levels and increasingly severe storms. Diana Olick has the details now in her continuing series on the rising risks to real estate.
At Manhattan's iconic Gramercy Tavern, where the menu celebrates locally sourced, sustainable food, something transformational is going on in the trash. Gramercy Tavern is one of more than 70 New York area restaurants donating their wholly eaten half shells to help repopulate the oyster reefs in New York Harbor.
When I learned a little bit more about their technique, then they had me hooked.
Oyster reefs are natural barriers that protect shorelines from erosion, rising tides, and increasingly severe storm surge. They knock down the height and force of waves, but they've been decimated by a century of over-harvesting and worsening water quality.
We've seen a loss of almost 80% of oysters in estuaries worldwide.
University of North Carolina professor Antonio Rodriguez studies oyster reef growth. He says the best way to protect the billions of dollars worth of coastal real estate from the effects of climate change is to go back to nature.
The goal is to keep people safe, keep their property intact, and sometimes making your environment more natural and learning from the way the environment was before we developed it. Those are the best techniques.
Oyster reefs are now being rehabbed from Massachusetts to Texas in projects by universities, local municipalities, the U.S. Navy, and Air Force.
This is the oyster hatchery of the New York Harbor School, and it's where Billion Oyster Project grows all of our oysters.
The Billion Oyster Project is one of the most ambitious. A twist on farm to table, it's table to farm, with a $3.5 million annual budget funded in part by state and federal grants from Superstorm Sandy. It collects 10,000 pounds of discarded restaurant shells per week, brings them to Governor's Island to cure for a year, then puts them in a hatchery where they spawn oyster larvae.
So right here you can see 2 baby oysters. Once Sandy happened, in the aftermath of that, we realized just how valuable oyster reefs in New York Harbor could be. New York Harbor used to have over 200,000 acres of oyster reefs protecting the shoreline, and that population is virtually extinct.
So our natural barriers to storm surge are gone.
Correct.
And you're telling me that this big old pile of oyster shells is going to save us?
I don't know, save us, but it should absolutely help.
The goal is to place 1 billion live oysters across 100 acres of reefs by 2035, bag by bag. In order to receive federal funding, projects like Billion Oyster had to prove that not only were they making the shorelines more resilient, but they were creating social resilience. That is, bringing even the largest communities together to protect their own real estate.
We want to engage communities everywhere because that's actually how you get long-standing change, right? If the community and the people that live there and work there are actively involved in stewarding their local environment.
We're lucky to live and work in New York City, where we have access to some of the freshest and the best, the widest variety of species anywhere in the world. But with that comes a responsibility of the choices that we make.
For Nightly Business Report, I'm Diana Olick on Governor's Island in New York.
And before we go, here's another look at the day's final numbers from Wall Street. The Dow fell 313 points to 26,164. The Nasdaq was down 132, and the S&P 500 slid 45. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.